Hello, Uncle Jim here. Did you know that selling options is one of the greatest ways to make passive income and you can do it in a very safe way? Today I want to share with you what I like to call safety tiers. I'm also going to share some tips and tricks that will keep your trading a lot safer. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's go ahead and jump right in. I typically like to give a quick market update. I don't think I have much to add to the previous week or two. I think the Fed's going to continue to hold rates steady. They may do a decrease middle of next year, depending on what's going on with the economy. And I think we're going to be trending up. I think we might have gotten the lows earlier this week or last week. And I think we're going to slowly trend up. I think the markets are still going to be very volatile. We're going to have some good days and some bad days, which lends itself well to selling options. I think if you're selling options, you can do better in this kind of a market. So and that kind of takes me to my next main point that I wanted to talk about. Now, a lot of people look at options as really risky. I don't think they're as risky as a lot of people think. And the amount of risk you want to take is kind of up to you. I'm started this what I call tiers, risk tiers. And the first risk tier is what I call just doing covered calls, as well as maybe doing the wheel, is one of the safest ways you can work with selling options. And it's relatively it's typically not very risky. Covered calls, I've been doing them for many years. And I think they're probably the safest type of option strategy. You know, when you identify a stock you want to own or you already own it since you're going to be doing a covered call, it's just a matter of picking that right price or strike where you're willing to give up those shares because you've gotten a good enough amount of profit that, you know, again, you're willing to potentially hand them off to someone else. And the fact that you can sell that opportunity and someone will pay you for the ability to maybe buy your shares is fantastic. So the risk is well defined and it's relatively small. Now the wheel I also think is fairly safe strategy to do. So instead of just buying a stock, why not sell a put, and you're selling the opportunity to someone to sell you shares and they're paying you for that opportunity. And this is especially true in the market we currently have. There's a lot of companies near their 52-week lows. And just like I was talking about before, you can pick a price, say the stock's at $40, you could pick a price of 35 and say, oh, I'm willing to own this stock at 35. Then you could use that as your strike that you want to sell your put and get paid for it. And if it gets assigned to you, you're getting a great stock at a great price. So I kind of look at that as tier one. You could actually add another tier where it's just covered calls, but I look at, selling cash secured puts or vertical put credit spreads is also very safe. So in my mind, that's kind of the level one tier, the safest type of option strategy that you can run. Level two is when you add spreads, and you'll know that this kind of relates to how most of the brokerages are set up. They typically have a level 0, level 1, level 2, level 3. So level 2 in my mind is doing everything you did in level 1, but then also adding spreads, where you're doing vertical put credit spreads, vertical call credit spreads. I don't typically do vertical call credit spreads because I feel like they're a little bit more risky and I got burned early on with them. So I'm only doing them in what's called iron condors, but I do a lot of vertical put credit spreads. And I kind of look at it as like a cash secured put. And if I can purchase a put for safety on the downside, then it's well worth it. Now, if you own a lot of stock, you could also do this to protect your portfolio. If you're worried, say you have 800 shares in Apple and you're worried it's going to drop to, 110, 120, you could buy a put at like the 140 range. It's currently, I believe, close to 180 to protect you below that 140 level. And a lot of people do that. That's how they kind of protect themselves in the market. So that level 2 tier is, again, level 1, and you're just adding spreads. Now, the most risky is, in my mind, level 3, and that's where you have everything from level 1, you've added spreads, and now you're doing much more complex types of strategies. You're doing iron condors, you're doing strangles and straddles. and it can get quite complex. And then you're also potentially taking more risk with more contracts, or doing something that really ups the ante. And I believe you should spend time in level one and level two and get used to those before you ever try any of these more complex strategies, because they are definitely the more complex. And if you're not sure what you're doing, you could really get yourself in trouble. So I just wanted to mention that mainly because I do have a lot of people who, they feel like options are too risky or they've had a bad experience with it. But you can really define how much risk you want to take. One thing you could do is just literally sell covered calls. Again, I did that for probably, I've been selling covered calls for 13 years, 10 years, probably all the way from 2010 to 2020. All I did were covered calls, and I actually never rolled them or closed them. I just let them expire. And I was able to double my dividends, and now I'm doing it on all my stocks. Initially, all I did it on was Coca-Cola, but now I do it on all my stocks. So if puts are nerve wracking for you, or vertical put credit spreads, or some of the other strategies, then I encourage you at least learn covered calls, because I've been very successful at doubling my dividends. So if you've got a portfolio that's paying you $2,000 to $3,000, you could double that and be making, $4,000 to $6,000. So you get the math, and it's fairly easy to do, and you don't need to do a whole lot of trades to be able to double those dividends. So I just wanted to add that you don't necessarily have to do all these strategies and all these different types of options. You can kind of pick and choose what's comfortable for you. And I do encourage you to start slow. Start with just something like covered calls or cash secured puts, and then build up into more complex things. And also keep the number of contracts down. Don't start with, 5-10 contracts, because that also makes it a lot riskier. Start with one contract until you really get used to it and you've had some success, then maybe go to 2 contracts. I personally never or hardly ever go above 2. If it's a really inexpensive stock, I've gone up to maybe 5 contracts, but I encourage you don't go over too many contracts. Now I may do more contracts, but they may have different expirations, so they're really different trades. I do a lot with IWM, which is the Russell 2000. I may have some expiring in November, some in December, some in January, some in February. And I typically don't have any more than maybe 2 contracts, possibly 4, expiring at that time period or on the same expiration date. And typically they're never the same strikes. They're usually at a different level of strikes. For instance, it may be 170, 160 as one vertical put credit spread. Another one is 165, 155. So again, limiting how much you risk, and then moving a lot of those expirations where you don't have too much expiring on the same day is really important. And then I also wanted to mention that, it's picking the right companies is also key. Having quality companies can make a big difference. And, by doing fewer contracts and wanting to own these companies, it's just a safer way to go. Now, typically when I'm picking strikes and I'm picking expirations, I will go farther out. And a lot of people ask me, why aren't you doing 0 DTE or 1 DTE or selling, weekly or month, or literally monthly? And part of the reason I do that is to reduce my risk. So if the farther you go out, let me give you an example. So if you only go out a month, your strike for, say, a $50 stock may be, and we're going to look at covered calls for this, so typically the price would be higher. So your strike for a 20 delta, and that's 20 delta is what I like to use, which is like an 80% probability it'll expire outside the money, or a 20% probability it'll be in the money on expiration. So if you go out a month, maybe it's, on a $50 stock, it may be a $53 strike that you need to use. Now, if you go out 2 months, you can higher that, and it may be a $55 strike. You go out 2 months, well, maybe it's a $60 strike. Again, identifying a high enough strike where you're making a really good profit on those shares that you already own. And the reverse is true with cash secured puts. So with a $50 stock, if you do a monthly, it may be, $48 is the strike you need to use. You go out 2 months, it may be 45, 3 months, maybe 42 or 40, and so on and so on. So that's partially why I like to go farther out. And, these contracts don't stay, they're not fixed. They'll change depending on the price. So if you pick a lower strike for a put or a higher strike for a call and the stock goes the opposite way, then it can become very profitable very quickly. So I very rarely will keep my contracts open through expiration. A lot of times I will close them before expiration or roll them. And I think what might be the nice area for that would be doing something like a 60 to 90 day expiration and closing them maybe 30 days early. And that's what I'm looking at doing potentially. The other quick tip or trick is, again, what I talked about with cash secured puts. I like having enough cash to cover any of my assignments that may occur. But again, when I'm doing that to protect myself, I typically will look to see if I can purchase a put and turn that into a cash secured put. And that tends to work really well. Give you, for instance, if you've got a $50 strike and the $40, and I like to go $10 spreads. If the $40 put is, $5, $10, maybe as much as 15 or 20, it may be well worth purchasing that put, again, to protect you on the downside. I've had a number of instances. I think I had it with Square. I think I had it with Schwab, where the strike price, because of whatever is going on in the market, drops below that put, and it also gains value when that happens. So it protects you on the downside. So in the instance of Schwab and Square in those specific trades, I ended up keeping the shares, but I ended up selling the put because they were worth a lot once, Square and Schwab were assigned to me. So it worked out really well. So I encourage you to look at, whenever you have that opportunity, can you buy the put inexpensively? So those are some of the finer tips. Those are some things that have worked well for me. Another big one is a planning worksheet, and I'm going to share my planning worksheet for this week at the very end of this video. But I identify anything expiring over the next 2 or 3 weeks. I put it on this planning worksheet, and I actively manage those. I put enough information that I need to have, I have what I need to have, meaning I put the ex-dividend date, I'll put earnings on there, I'll put the strikes, I'll put the delta that was in there, I'll put the current price. And I use that planning worksheet to identify what I need to really focus on so that I don't miss some opportunities. Again, I'll share that at the very end. Now, another important part with managing is also how deep you are in the money. I get the question a lot of, am I going to get assigned early? Now, the probability of getting assigned early is pretty rare if you're just slightly in the money. Of course, if you're out of the money, you never will get assigned early. But the deeper you get into the money, the more likely you are to be assigned early. And the best thing to do is, again, keep track of how deep you are in the money and see if you can roll out and down, especially for a put or for a call, rolling it up and out. Now, I've had many positions that have been open for a long, long time that have been in the money and have never been assigned. I think, Con Edison, that's over 2 years it's been in the money and never been assigned. So again, the point being, don't panic. It's also key to understand, do you really still want to own that stock? So has something changed fundamentally with the company? So kind of do research again, how much debt do they have? Are they growing, or do they have dividends? Are they growing their dividends? Is there a chance they're going to cut dividends or eliminate dividends? Look into key criteria. Be sure you still want to own that company, especially if it's fairly deep in the money. And if you have to, close it for a loss if it's a company you don't want to own. And then another thing that you can do is you can do what's called stop loss orders. So you can, once you put in your primary trade, you can also put a stop loss saying, I want to close this automatically when it hits 50%. Now, Schwab doesn't make it real easy to do that, at least through their main interface, but a lot of the other brokers do. So that's something else you might want to look at to ensure that you're closing it before you take a big loss. So let's jump into the next part of the video. I'll share quickly my my planning worksheet that I'm using for this week. And as always, I do want to mention, please hit that like button, subscribe. I'm trying to still grow this channel, trying to get more people interested. In my description, I'll have information for my memberships. I've had a good number of people join. There's some really good dialogue and discussions, and you get access directly with me. So if you're curious about that, take a look in the description. And with that being said, let's jump into the next part of the video. Okay, this is this week's planning worksheet, and I release this every Sunday to my membership, and I share at the top are some of my top picks or favorites for the week. These are companies that I research usually over the weekend, and I will identify I'll identify what type of strategy, what their current price is, what the short strike is, what the outer strike would be, expiration, what the delta is, and what the typical premium would be for these particular companies. For this week, I had Polaris, PII. I've done quite well with Polaris. I currently don't own it, but I've sold many vertical put credit spreads on it. Cube is another one. I think I've only done one trade on them, but they are at a good price. At one point, they were really expensive. Zoom, if you follow this channel, Zoom's one of my favorites, not just to use with my membership, but I like the company. They make good money. They have no debt. And then EMN is I believe it's an oil and chemical company, and it's at a good price, near 52-week low. A lot of these are near their 52-week low, so good companies to look at. Now below that, this is what's expiring in the next couple of weeks. Again, I released this on Sunday, so all the 1 through 4 is what was originally on it. 5 through 11 are my new trades. So initially, all I had was BMY was deep in the money. It did get assigned to me. I now own it, and I've actually been selling. I sold some covered calls on it, and I really like Bristol Myers. I do think it. Right now, I believe it's around 57, 56. I do think it'll get back up to 65. So I have taken a little bit of a loss on it. But again, it's another company I wanted to own. WBD, this is from AT&T. I'm looking probably to roll it again, either this week or next. Big lots, this is one of my worst trades. It's really taking a beating. I think it's $4 or $5 now. So I'm probably going to look to just take the loss this year. I was looking to see how I was doing this year, and I've got some pretty good capital gains. So I'll probably take the loss of big against those capital gains. And then BEN, which is Franklin Resources, and it's another covered call, 1020. And I'll look at opening a new one or rolling it. I may let it expire. I believe it dropped down to around 25, so it is fairly out of the money. So, and then these are my new trades. I did a new trade in Zoom. Now, for those of you, my subscribers who, haven't been in my membership, I did take my 401k in Fidelity. I moved it into a IRA at Fidelity, and now I'm set up to actually sell options in this new account, and it pays a really nice interest rate of 5%, and that's on the funds that are sitting there that you can use to trade cash secured puts or vertical put credit spreads. So I did a new trade in Zoom. I did 55.45, and it's like a 65% yearly return. 213.40 is what I brought in, and required capital 1786. So I've done really well with that price range. 55.45 just seems to be a sweet spot with Zoom. SDY, this I've talked about in previous videos. It's another dividend ETF. It's one I want to get rid of it and actually replace it with SCHD, but it's funny. I keep selling covered calls that are near the money, and it just never gets called away. So I did another one. The current price, I believe, was 113, and I did. Did I not write that down? I believe I did 116 was the strike. I forgot to put that in there. So let's put that in there. And so it was fairly close to the money. Brought in 210, and this is almost a 13% return, mainly because the expiration is November, and that's my cost basis for this. So it's worked out pretty well, even though it's not my favorite ETF, dividend paying ETF. It's still a really good one. Next is Procter and Gamble, and I've owned Procter and Gamble in several of my different accounts, and I just did another covered call. I went out to January 19, 2024. Current price was 144.95, and I did a 165. Actually, was this a roll? Yeah, it was a roll. So I reduced it from 165, I believe, down to 162, I believe, and I brought in 229, and this was like a 3% based on the high cost basis. So it definitely was higher than, I believe, the dividend. Now the dividend is closer to 5%. So I've been able to sell a lot of good covered calls with PG and or Procter and Gamble, and it's worked out really well. So, but both of these were in my existing accounts. Now this is another trade with my Fidelity account. GLW, which is Corning, has been way down. So I did a cash secured put at 29, which in my mind is a really good price. The current price was 29.50. And for that cash secured put, I brought in 192. This is the required capital. So this is like a 31% return. So if you followed my videos before, I really like Corning. I think they're a great company, and right now they're fairly cheap. Next is BMY. This is the one that get assigned to me. I sold a cover call at 60, which I believe is slightly below my cost basis. The cost basis is like 63 when you factor in the vertical put credit spread that I sold with it. So it's fairly close to that cost basis. At that time, the price was 56.83. I brought in 174. Here's the cost basis, 12,825. Again, because it's a covered call, I'm using the full value. And it's like almost a 7.5% return. I believe that one was December 15th. So I definitely should be able to roll that or maybe we'll probably roll it sometime in November is what I'm thinking. Next is CF. I believe they also are a chemical company, good company, well run, pays a nice dividend, grows that dividend, has a good handle on debt. Another new trade in my Fidelity account, vertical put credit spread, 72.50, 62.50, and I believe the 72.50 is not quite to their 52-week low, but it's fairly close. And this was expiring on 1/19/24. At the time, it was almost 83.68, so pretty close to 84. I brought in $265, and the cost basis was $17.34, and that's just the 2,000 minus the 265. And this is nearly a 56% return, 55.83. So worked out quite well. And then this trade I actually did today, it shouldn't be 10.23, it should be 10.13. And it was a roll. I rolled Intel's covered calls. The ones I currently had were 36, expiring on 1/19/24, and I rolled them out. This is actually a leap. Currently, Intel got up above 37. I rolled it out to 1/17/25, which is definitely a leap. It's over a year. Anything over a year for selling an option or buying an option is considered a leap. And I upped the strike price to 42.50. So from 36 to 42.50, which is 42.50 is above my cost basis. not even including whatever I brought in with this covered call. Now, I don't think Intel's going to get up to this level next year. It may. If it gets up to 45, I shouldn't have an issue rolling it up to 45 is what I'm thinking. I brought in $380. This is the cost basis, 17,115, and it's a 1.75% yearly return, and that's actually for the leap, meaning it's got 463 days. So it's still more than double the dividend. Again, giving another example of doubling the dividend. And every covered call that I did in these trades, which I've got 1, 2, 3, 4, and I believe all 4 of them, more than doubled the dividend. So again, like I mentioned earlier in the video, if you just do covered calls, it's fairly simple to double your dividends. So something to keep in mind. So this is what I use. I keep track of important information, the delta, expiration, any key information that I need. So that's it. That's what I wanted to share with you. Having this worksheet to work with helps me a lot during the week, especially like I knew BMY was going to be assigned to me. It did get assigned early. It was expiring not this Friday, but next Friday. So I was kind of waiting for that to potentially be assigned, and it was fairly deep in the money, and that's why it was assigned to me. Here you can see it was $58.90, and the strike was 65. So another example of the deeper you go in the money, the more likely you are to be assigned early. But again, it doesn't always happen. In this instance, it did. Other instances, I've seen it go right up to expiration and occur on expiration. So as always, if you have any comments, you're curious about something, please leave a comment below. I typically try to answer all my comments. And as always, thanks for joining me, and I look forward to seeing you the next time.